we've looked at the drivers of capex very carefully, and there are a lot of things that matter. One of them is strength of balance sheets. I think we are doing well there. Both corporate and bank balance sheets have improved through the pandemic, but then there are some other things that are not working on our behalf. One is global growth. It's slowing. Generally, capex cycle have become far more coordinated globally. So if global capex is weak, then it's hard for Indian capex to sort of outperform. Then the other is macro stability. With inflation that is high, the current and fiscal deficits that are wide, it's sort of not creating a very stable environment. And the final one is the outlook on GDP growth. We're in the middle of a storm, right? It's very difficult to get a good read on GDP growth right now. So I think these things are coming in the way of a new capex recovery. But once I think the global storm settles, our macro indicators improve, we have better visibility on GDP growth, I think we will be in a good place to start a new cycle of private capex. I think that the next couple of quarters are going to be tricky. We are seeing many indications of global growth, finally slowing. We are seeing the tech cycle slowing. FedEx recently spoke about how, their data is one of the worst they've seen in several years. So I think at this point, it's very hard to really, put a date to when the capex cycle will start in earnest, but I think not the next couple of quarters. Dollar has strengthened 14% since the start of the year. The rupee has only weakened 7%. I would have imagined that it would have weakened more given it's a big oil importer and we're in the midst of a commodity price crisis, right? So my sense is that the rupee should have weakened more. Of course, the RBI is keeping it from crossing the 80 mark. I think if it goes to about 82 or something, basically shows about a 13% depreciation since the start of the year, it will be a good thing. It will make our exports on the margin more competitive in the global market. It will disincentivize some of the unnecessary imports. And also, if once people get a sense that the rupee is fairly valued, then some of the inflows could start again. So in my sense, if the RBI lets the rupee depreciate a little bit from here gradually, I think it will hold the economy in good stead. So look, currently I think there are just too many shocks all at once in the inflation print. Very hard to disaggregate how much is coming for where. We still have the shock which we saw back in March when all the commodity prices were at record levels. That shock is still passing through. So first it attacked rural inflation, now it's coming down to urban inflation. First it attacked goods inflation, now it's flowing into services inflation. And before that has even passed through the entire system, we've seen a new shock, which is the shock on the back of weak sowing in this monsoon season when the rains were a bit patchy. So a new shock has come. So I think generally speaking, inflation is in a vulnerable spot, and I think some more RBI tightening is needed at this point. And I think over the next couple of months, the question will be, is RBI happy enough if inflation falls under 6? Which is its upper bound, or does it want to drive inflation all the way down to 4%? My sense is that if it's happy as long as inflation is under 6 and close to 5, we'll see a couple of rate hikes, but after say 2 or 3 of them, it'll stop. But in case the RBI wants to drive inflation all the way to 4, which is its target, then I think many more rate hikes will be needed. My own sense is that the inflation target has to be revisited at some point. There have been a lot of structural changes in the whole world economy in the last couple of years. Trade is changing every single day. Prices across the world, especially in developed markets, is very high. So we'll have to see what the realistic new inflation target is. And I'm sure RBI is working on that.